I'm just going to wrap up here in the next two slides, but our strategies are indeed shaped by these new era financial conditions. We think we're in this new era, what we call post-financial crisis era. I mean, these are sort of fancy words for just saying that there's too much debt in the system, and the debt has to be exterminated somehow, and that takes some time, right? It takes some time to heal through that. And I think we're about halfway through that, so it's not to lose hope there. But what I'm showing you here is a portfolio construction for one of our more popular mandates, which is the International Balance Mandate. And you'll note that the horizontal dark lines there are the strategic benchmarks. So again, we sincerely believe in having a strategic composition of your portfolio. That's the best defense against volatility. But we've also enhanced and supplemented that strategic with a tactical range. So Canadian equities, as an example, in our portfolios have a 25% strategic benchmark, but we're allowing ourselves to go up to 45% and down to 15%. And that brown diamond is where we are within that range. And we think that's incredibly important to have that tactical component, just because markets are more volatile. We think they will continue to be more volatile for at least the next 3 to 5 years. And that's incredibly important. If asset markets are changing, then obviously the underlying risk-return composition is changing as well. So again, it's not day trading, it's just making these sort of institutionalized, disciplined decisions and trying to make that. So you can see, as an example, US equity, we're overweight right now. I think this was for Q1 2013. Canadian equity, we're underweight because of the commodity thing. Bonds were slightly underweight. This tends to be more into US bonds and international bonds. But it keeps us honest, right? It keeps us sort of aligned with those long-term strategic conditions, but also gives us some tactical agility to respond to this incredible volatility. And what I say always is that this is the basis this is the start with anything. Any portfolio that you have should start with a strategic policy mix, like a 60-40 portfolio. But I think in this era, you can go beyond that, and keeping that as a foundation of your portfolio. Keep that as the foundation, and let's look at some different things. Let's globalize our equity allocations. Think beyond traditional fixed income allocations. We do have other things that look like fixed income that can supplement and replace some of that, those assets in there. I mean, Winston highlighted the bonds are going to be, the outlook's going to be quite challenging over the next few years. I certainly agree with that. And then look to some of these thematic opportunities, which again, you can provide through ETFs. ETFs have democratized investing for a lot of us. And it's made the portfolio construction a little bit easier, but it's also made the demands on the portfolio managers a lot larger, because now all of a sudden I don't have to just worry about Canadian equities. I have to look at stocks in the emerging world or debt in the emerging world. And the skill set wasn't always there in the 80s and 90s. And so we think it's a happy story. ETFs are, Paul Volcker once said that the only good financial innovation in the last few years has been the ATM machine. And I think I have to add to that ETFs, because I think ETFs are something that has made the portfolio construction so much better. But it's a new thing. So we think we've supplemented it and made portfolios more robust to the challenging era that we find ourselves in.